Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Regulatory news coming out for our friends at Amazon. Amazon and the Federal Trade Commission, they reached a $2.5 billion deal in that Prime subscription case. Let's bring in Spencer Soper. He is a Bloomberg tech reporter. Spencer, can you remind us of what this case is and then what the settlement does?
Yeah, so this is about Amazon making, kind of duping consumers into paying for Prime memberships. So the FTC alleged that, they tricked people into signing up through free trials and then made it difficult for them to cancel their Prime memberships if they wanted to. Internally, at Amazon, they even had a term for this cancellation process called the Iliad, which kind of referred to Homer's epic Odyssey. So there was some pretty damning findings about how Amazon handled this. The settlement is $2.5 billion. $1 billion will go to the U.S. Treasury, and $1.5 billion is for consumer refunds. People will be refunded automatically if it was found they were affected by this case, and you're looking at about $50 per affected consumer. So it's no huge windfall for consumers. And even for Amazon, $2.5 billion is probably like a parking ticket for you and me. But it puts this thing to bed and prevents Amazon from going to a trial, which probably would have been pretty embarrassing.
Okay, so that's what they want to avoid. Just give us some context here about how valuable the Prime program, Prime membership is to Amazon. I know that they don't always give a lot of numbers. The numbers that we do get have to do with how much it costs members. But in terms of the actual number of members and the amount that they spend, aside from knowing that they spend more than regular Amazon customers, we don't have a sense of how much they contribute to margins, for instance.
Well, it's a huge part of Amazon, and the financial nitty gritty I really don't have. But you're talking huge penetration in the U.S. More people live in a home that has a Prime membership that don't. So they've got a majority of the country, and then, to your point, if you have a Prime membership, you're paying Amazon $140 a year or $15 a month, and so you're more likely to buy things on Amazon. And so Prime members spend about twice as much on Amazon as non-Prime members. So it's a critical part of the success. It's also very sticky. People tend not to cancel, which is why this I don't see this as being a huge deal, this settlement. It's kind of like Amazon puts it to bed, but by and large, most people who join Prime are happy with it and stay with it. This was just kind of more of an embarrassment for them. Yeah,
I think we find it of huge value in our home. President Trump is still speaking with President Erdogan in their bilateral meeting there in the Oval Office of the White House. We will bring you headlines, and the red headline just crossed the Bloomberg terminal here. According to President Trump, we want Erdogan to stop buying oil from Russia. So that's consistent with what the president has said, and we'll bring you more reporting on that. Spencer, what else is in front of Amazon, just in terms of some of the regulatory issues facing it? It's really hard to keep track of what's going on with some of these big tech companies and the regulatory headwinds.
Yeah, that's a good point, and people should know this is an FTC case against Amazon that was specifically against Prime membership. There's still this whole question, this big antitrust lawsuit against Amazon, which is basically saying, this company is so big and has so much control and so much power that it's impossible for other companies to compete. That's still pending, and that's really the big threat to Amazon, and that's a holdover from the Biden administration. So in terms of the regulatory framework, the significance of this Prime settlement is largely, like, a lot of people are wondering, okay, President Trump took office and there were a lot of these FTC cases pending against big tech companies like Amazon, from the Biden administration. What does the new administration mean for these cases? And so that's really the big question here that we're still wondering about is Amazon was able to put this this kind of smaller Prime investigation to bed and pay a little fine. But what is the what is the outlook on these bigger cases that are more of an existential threat to Amazon?
So what is kind of what's the feeling out there in the West there with Silicon Valley and up there in Seattle area about this administration? Is this administration that can ultimately continue the light regulatory touch that the tech industry has always enjoyed, or maybe they won't be able to deliver on that? How concerned is greater technology, greater Silicon Valley about the regulatory environment?
Well, I think that they're all trying to very delicately figure out how to finesse their way through this administration. I guess I think if Trump is anything, he's unpredictable. Right. So I don't think that they take anything for granted. And that is a good question. And I wish I had a nice, simple answer for you.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Starbucks, and this is round 2 of layoffs under new CEO Brian Niccol. Although, can we still call him new?
No, I don't know. No, he's
been
in
like
there.
1 year,
He
right?
owns it.
Okay,
Yep.
he owns it. So let's bring in Michael Halen, who owns the restaurant news coverage for us here at Bloomberg Intelligence. He is our senior research and food service analyst. Michael, when you hear the news about Starbucks closing stores, cutting jobs, 900 jobs, $1 billion restructuring effort, it feels like deja vu.
Yeah, but you know what? This was very clearly communicated to the street back in April on their fiscal 2Q call. Management said that, we expect more restructuring charges. We're going to continue to evaluate our store base. Really, management wanted new CFO, Kathy Smith, to be involved in the process. So this was not a surprise. If we hear about some more store closures and restructuring, then maybe you'll see a bigger reaction in the stock.
All right, a shout out to my Starbucks on Route 35 in Wall Township, New Jersey. They do a great job, great folks, very efficient, very good. Mike, what does this company need to do? What do they say is on their to-do list to turn this company around? What are you looking for?
Yeah, it's more operations and marketing, and we're starting to see things kind of inflect here. We think fiscal 26 should be a nice bounce back year. So. First it's with the operations, right? So it's eliminating menu items, increasing labor, which baristas were very happy about, creating a smart queue for mobile orders, right? So the stores aren't as chaotic and baristas aren't serving, mobile orders for somebody 30 miles away before helping someone inside the store. And then service standards, right? They're rolling out these green apron service standards this year. It's a big investment on training and really nailing the consumer experience in the store. And then from there, it's the marketing, and marketing seems to be working. They pulled back on discounts, and what they're doing is more marketing. You'll see some TV ads, right? They're doing more digital marketing. And we think that's a smart move. It seems to be paying early dividends. Starbucks non-rewards member transactions are up. Non-discounted rewards members transactions are up. And we think these are a sign that sales are going to inflect higher in the coming months.
Okay, but this is taking a while. Paul and I are just saying that Brian Niccol owns this now. He's been CEO for a year, and they're still in turnaround mode. They're still in kind of like, let's figure out our path forward. Investors, please be patient. Are investors going to continue to be patient for another 6 months to 1 year?
I don't think they're going to be patient for 6 months to 1 year in terms of the stock price. I think Brian Niccol's job is very much safe. You can't turn around an aircraft carrier on a dime, right? This is a massive organization, 18,000 stores just here in North America, over 40,000 globally. So yes, this is taking longer than a lot anticipated, myself included. Are investors going to be happy if they don't see same-store sales inflect here in the first quarter of fiscal 26? No, they're not going to be happy, and you're going to see it reflected in the share price, right? So, I think they're making the right moves. This has been a longer turnaround than most had expected, but I think Brian Niccol's pressing all the right buttons right now.
Yeah, I just got back from some vacation time in Italy. I don't think I saw too many Starbucks in Italy.
I think they have a Starbucks Reserve somewhere. It looks different than the regular Starbucks store.
All right. So, Mike, I mean, you said they have 40,000 stores on this planet. Is that enough, or are they still going to be putting more out there?
They're still going to be building. I think they need to, they're going to have to nail this U.S. operation and remodel, and they're going to spend a little bit less on building stores in the U.S., a little bit more on renovating them.
Okay.
And then China, they really want to get that market nailed before they accelerate growth. So those are their two main markets for growth. They've been the company's two major markets for growth for a long time. But management's doing the right thing. They pulled back on growth to kind of nail the operations, the marketing. Once they get same-store sales and traffic trending back up strongly again, you'll see them reaccelerate development.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Boy, some big news today if you're in the used car business. CarMax, Richmond, Virginia-based company, stock down 20% today. Some disappointing results and guidance here. Let's get the bottom line here, what's going on. Steve Mann, Bloomberg Intelligence, Global Autos and Industrials Research Analyst, joins us here. Steve, just tell us what's going on with CarMax. The stock down 20% today. What's the news?
Yeah, it's significantly down today for a couple of reasons. One is the auto sales, used car sales, wasn't as good as expected in the second quarter. And then secondly, it's really on the write down on some of their loans. And the first item is actually it's not that surprising because there's been a lot of pull forward demand. Remember in the first quarter when Trump announced these tariffs on autos, a lot of the consumers actually went ahead and bought a lot of cars in concern that prices will go up. So the pull forward demand really dented second quarter sales.
Talk to us about the other side of the equation, kind of the write-off of some of these auto loans here. Is that unusual for CarMax?
Well, I mean, this is because this is on the back of the Tricolor Holdings bankruptcy, if you remember. They actually went bankrupt because they wrote a lot of subprime loans that on potentially undocumented, allegedly undocumented buyers. But this seems to be more of a unique case for Tricolor Holdings. So the write-down is a little bit kind of special given the coincidence that's with the Tricolor, but it's not out of the ordinary for these auto companies to actually write down some of the loans. The interest rate has been high, right? I think the bright spot now is that the interest rates are coming down. So we don't actually see that is an industry issue, but it does cause for concern. It's not a red flag. I would say it's more of a yellow flag.
Talk to us, let's step back a little bit. Talk to us about where we are in the auto business with just how many cars are being produced these days in the U.S., and what does that mean for the used car market, like the CarMaxes of the world? Where are we today?
Yeah, I mean, it's about the annual sales in the auto industry today in the U.S. It's around 16 million. If you include Canada and Mexico, it's around 18, 19 million. The used car market is actually bigger than the new car market. It's a very vibrant market. And look, it's an interesting market. There are a lot of used cars that's coming back from leases. I remember during the COVID era, we had quite a bit of vehicle sales, and prices were really high. And so there's quite a few used cars coming back in the market, and that's impacting prices as well. So even with lower prices, used car sales was down in the second quarter. But then again, it's a function of the pre-buy that happened in the first quarter. So I actually feel that we're probably near the trough, given that interest rates are actually coming down.
So, we talk about the SAR, the seasonally adjusted rate of 16 million. I remember back in the day, 17 million was kind of the norm here. Is this a new, lower, normal level of production from the U.S. OEMs?
Yeah, you're absolutely right. We haven't really gotten back to the pre-COVID days of 17 million SARs. But I think this is a new normal of 16 million. Look, the average price for a vehicle has actually gone up quite a bit.
Yep.
Today, it's about $48,000 per vehicle. Before COVID, I think we were, around 40. So a significant increase since then. So there is some concerns about affordability. You've seen financing terms being extended. Car buyers actually can get loans for 72-month loans up to 84-month loans just to make the vehicles more affordable. So I do believe this is a new normal. I don't see prices coming back down. Prices don't usually come back down once they're increased. So I think this is going to be the new normal.
So does that mean people are staying in their cars longer because the affordability of getting a new car is that much more difficult?
Yeah, that's a great question. I think they are going to stay in their cars a little bit longer. Look, the cars today are much more reliable, much more durable than they have in the past. So they do last a little bit longer. And if you throw in EVs, right? EVs, it's probably around 4 or 5% of the total fleet today. Those last also a lot longer with less moving parts. So who really benefits are actually the aftermarket retailers like O'Reilly and AutoZone. As people keep their cars a little bit longer, they're probably going to either go get it repaired by the dealer or the mom and pop shop, or they do it themselves.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.